If you're new to investing or starting out or simply want to improve your financial knowledge, we'll hope you're in the right place. Because the one thing we don't teach people is the word about personal finance, the world of investing. It's considered the two or confusing to discuss. So hopefully you're now taking the right steps. My name is Dave and I work in financial services and I help people access their private personal pensions, something which is complete inertia to most people. So the aims of the videos, my finance blog, is to improve people's financial knowledge, well-being, so you can reach your goals sometime in the future. Now I've applied these principles to become a net millionaire at the age of 52, so if I can retire, you can do it, but let's get into the later video. This video is about my ISA review, my stock and shares ISA for August-September 25. Now it's not to boast or brag or say look at me, but to give people hope. If I can think long term and build a subscriber portfolio of 6 figures, you can too. So what are the aims? Well, we're looking at annual growth of 10%, dividend to 2025 of £5 grand for this year, and a year-end value of £153,000. So how have we done the month? Well, we started at 156,809. We finished at 159,958. So a profit in the month of just over £3,000. Year to date, 20.09%, so well above expectations. Look at the following graphic. We put contributions in, increase in the month of £617, so tax year just over £3,147. Our platform providers charges fees based on a portfolio of £18.65 percentage. So where is the portfolio held? Well, predominantly UK based, nearly 6% in UK and Europe, 30% in America and USA, and 10% in Asia and emerging markets. If we look at the following graphic, we had a surprisingly small or low month for dividends. We will have good months, we'll have bad months. But we received one dividend, £18.1p, from an emerging market fund. Now it's a new accumulation unit, so it was reinvested back in the fund automatically. But across our shares, we've got an average yield of 5.18%. Year-to-date dividends of 3362, so bang on target, but that will increase dramatically in September. But it just goes to show we'll have good months, we'll have bad months. But we will reach our objectives through the course of the year. Now let's look at, shall we say, of the funds and the shares held within the portfolio. Let's look at the funds in the portfolio. At the moment, we own 51% of our funds, 9 funds, 5 in profit, 4 showing a small loss, but collective value of just over £82,500. Our largest holding is Passive Ventures Fund done through our platform provider AJ Bell, just covers the markets. £26,000, 6% of our portfolio, but given its annual return last few years of around about 10%, we just switch off. Our second fund is a Fidelity World Index Fund, somewhat similar but reduced fees of 0.12%. Now during the month we put £11 at the top up, but it's £21,000, 30% of our portfolio. Again, average yield last year around about 10% annual performance. We own an LNG technology fund, nearly £20,000, 12% of our portfolio. Slightly higher fees, but as we've all known, the tech sector has done very well the last few months, last few years. Let's see what happens moving forwards. But again, we just switch off. So 3 big funds held. Now some funds that have struggled are the Fidelity China Fund. Nearly £3,000, 3.9% of the portfolio. It's had a good run for the last few months, but it's struggled over the past few years. We've got 2 emerging market funds. One of £1,500, 0.92%. And one of £1,400, 0.87%. Frankly, small funds. Now they're nearly back in profit, but when they're back in profit, we're going to, shall we say, put into our passive funds. One, to reduce fees, shall we say, and costs, and to simplify the admin. Our worst fund now is a Russia fund. We put £500 in, went to 600 plus. It's struggled ever since. Now it has recovered lately, but it's still only worth £286. But frankly, it makes up 1.1% of our portfolio. We're not prepared to sell at loss, but it just goes to show we invested in a specific country and it backfired, but we're not prepared to sell at a great loss. 2 funds we've done, shall we say, for ring fencing. We put £3,000 in S&P 500 funds, £3,000, it's now worth 3.6, 2% of our portfolio, and an FT All World Index Fund. We put 5,000 in, it's now worth 6.2, so nearly 4%. But we've done it because we didn't want to invest our existing holdings. We kept that money for ring fence, but we've done it simple funds. We just switch off. So we've got a collection of funds. Some passive funds with low fees, just does what it says the tin, done for diversification, and we've got some funds that have struggled, China, emerging markets. But it just goes to show you're not going to get every fund right, but we will simplify them funds moving forward, but by their own personal selections. Okay. Let's look, shall we say, at the shares we hold directly within the portfolio now. We own 10 individual shares, all based in the UK, and all in profit. Makes up 48% of the portfolio, of which 42% in the FTSE 100 and 6% in the FTSE 250. Total values £77,220. Now, all long-term players, we've got no selling shares, but actually topping up when we get annual dividends reinvested automatically. So what do we hold? Well, predominantly, shall we say, financial services, what we know about. We own loads of banking group, 20,703 shares, £16,500, 10% of portfolio. It's got a nice yield of about 4%, and it will pay a very nice test dividend later in September. Very good results lately, but shall we say, under pressure because of the court ruling with the car finance scandal. We own L&G, the insurer, 5,462 shares, £13,500, 8% of portfolio. A very nice yield of around about 9%. It will pay a very nice dividend at the end of September. We own Aviva, 1,980 shares, nearly £13,000, 8% of portfolio, again a yield of around 8%. Very cash rich, has been, shall we say, on a buying spree. It is growing, but a very good track record over the past few years. We own NatWest, the banking group, finally in full control with the government. Has had a great run during the past year, over 50% in profit. 1,261 shares, £6,500, 4% of the portfolio, and again, a nice yield around about 4%, will pay dividends at the end of September. We also own Barclays, the banking group, 1,680 shares, £6,000, nearly 4% of the portfolio, again, a yield around about 4%, and again, it will pay a nice dividend during the month of September. And then finally, shall we say, an overseas bank, or mainly probably overseas, HSBC, 555 shares, £5,500, 3% of the portfolio. It is cash rich. It was probably the worst results of the company's recently reported, but it does pay a nice quarterly dividend. Now, other shares we own is AJ Bell, the platform provider, 991 shares, £5,000, 3% of the portfolio. But assets under management increase. It's what we see as a growth company. It pays a small dividend, but it's growing rapidly, mainly through online platforms, or mainly, shall I say, through investors, financial advisors applied to network. We own one company, shall we say, in pensions, what we know about, Phoenix Group. It's bought recent players lately, but shall we say, a big player within the UK auto sector and the buyout sector. We own 666 shares, £4,500, nearly 3% of the portfolio, but a very nice yield, if it's sustainable, of nearly 10%. Now, away from the banks, we own Card Factory, 4,114 shares, just over £4,000, 2.6% of the portfolio. Very cash rich, is seen as a growth company, is expanding the high street, shall we say, and other sectors, but it's been on a buying spree, okay, and dividends being increased, but what we call a growth company. And then finally, we own, shall we say, a food retailer at Sainsbury's, 923 shares, £2,700, just under 2% portfolio. A nice yield around about 5%, is in a price match war with Aldi, but profits increased. But it has been affected, shall we say, by the minimum wage, national insurance increases, because obviously the cost for the staff. But it just goes to show we've got a nice collection of shares, all big names. They're still going to be in 10, 20 years. We just switch off, and they will pay some very nice dividends during the month of September. And it will be reinvested within the existing holdings. It just goes to show, if you think long term, you can create a portfolio over sizable figures, mind over 6 figures, but not to boast or brag, but invest on a regular basis within a tax wrapper and think long term. If you like the videos, smash the like button, subscribe to the channel, and we'll see you again in the next video.